Hi, class. Welcome to Business 123's Chapter 3, of course, and it's going to get into a little bit of introduction to stocks, the stock market. How do we buy stocks? What are stocks? Does it mean that we own companies? Let's get into all of that. This slide right now, you're going to actually be able to see on your own. It is a video of course, Homer Simpson trying to invest money in the stock market, and he's trying to be sneaky about it. Take a peek at this at your leisure, but I wanted you to have an option to, see it. I can't play it on here for some reason because it doesn't follow the formatting for PowerPoint. So what are stocks actually? Basically, a stock is ownership in a publicly traded company. What does that mean, publicly traded? That means that they actually are on the stock market, which is Wall Street, and they are allowing the public to buy some of their stock to build their company out. Some of them might need additional capital. They might need the opportunity to be more diversified. That's the purpose of actually being allowed to buy stocks in publicly traded companies. Stock also is a claim on the company's assets and earnings. The more they make, the more money comes into your pocket, hopefully. Now, there's of course risk and returns that you have to consider from chapter 2 we talked about, and also chapter 1 kind of touched on that. The more stock you have, the greater your claim as an owner. Now, very important, you have to have a significant amount of stocks, let's say in Apple, to have controlling interest in the firm. So this is for the more high-end investors, this last statement. For you as a typical investor, for me as a typical investor, we'll have basically bare minimum impact on how the companies run, but we will get some of the dividends and returns. Some of the top stock picks we know right here: Hertz Rent-A-Car, Apple, Facebook, Google, insurance companies, car companies, Microsoft, software companies. There's moments that you say, I would love to invest in some of these particular areas. Well, rewind to chapter 2, which talks about mutual funds. All of these particular companies could be combined in one mutual fund account, which means they can use these companies to allow you, as the small time investor, to actually buy stocks in these companies. Because you can look right now, just Google it. You can go through, what is it called? I just had a brain explosion. The financial websites. I'm trying to think. Why am I not? Anyway, you can Google it and find out how much each stock is worth in a company, and that's how you buy in. For example, Google could be like $480 per share of a stock, one stock, and some of them have a minimum purchase of 100 shares. So we're talking 400 times 100. That's a lot of money. Do you have it? No. You might want to turn to chapter 2 and think about mutual funds. So the type of stocks we have: common stock, which is most commonly offered by most companies. It's the most common form of stock. You get one vote per share, and the dividends are not guaranteed. That's common stock, which means common. Preferred stock, a little bit different. There are fixed dividends. They're going to guarantee you. Well, I take it back. Not guarantee you. They're going to try to assure you that you will receive some profit before the common stock people. Let's make sure that's clear. And you may not always be included in the voting process. What do you care about voting? Well, the voting actually is allowing you to understand who the board of trustees will be, or the board of directors, or the CEO. You'll have a little bit of a voice in who's going to be running, let's say, Apple or Facebook. Okay, and companies may customize other classes of stock. Google did that. They're called alphabet stocks, and different levels of stocks are offered through Google. If you need more information on that, please jump up on YouTube University. It'll explain why Google branched off from just regular common stock, preferred stock, to a different kind of stock that only certain people kind of know about. And that became very controversial. So all securities are traded on the stock exchange, and they have a ticker symbol. Some of them are pretty easy because you know how you'll see that tick, 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 tick when you see the stock market, on the bottom of your screen or something. And you're like, okay, who's that? That Gigi, Baba, la 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 la. They all have their own individual designators. Like here's Microsoft, Southwest Airlines, and so forth. And some of them you really have to know. Ford, just an F. Google, Goog. I'll probably guess that ticker symbol means Google. But if you don't know, just look it up. The initial public offering, IPO. This is what companies do when they first become a publicly traded stock for the public. And it's sold in the primary market, which means the very first market. Stock on Facebook right now is at an all-time high. If you get a chance to invest in Facebook, more than likely you've invested through mutual funds because of the fact that it's pretty hard to invest and get a substantial amount of stocks, I should say. You can invest, but it will be very hard to make a major profit, specifically from Facebook. Now, the question you should have is, well, Facebook is very popular, it's very huge, and it's been around for years. Why do they want to do a public offering? Why would they need to be public? One individual, created, you see him in the middle there. Why go public? It's a private company. Several different reasons, come into play when you decide to present an IPO. Either you need to raise more revenue for your company, which means you want to expand, or you just want to present maybe a great product to the world and have them have a chance to kind of buy into your company. But there's several other reasons as well. Here is the top largest US tech IPOs from 2020. Let's go back 5 years. So if you had a chance to invest, look at how the difference, look at the amount of money you could have made if you got in on the ground floor of their IPOs when they first went public. And you can see right there, without me reading all of those companies, you can see some of them just blew up. Look at Facebook. Years ago, when I grew up, I heard of millions and I heard of 100,000s. Everything that happens now is in the billions. So either our country has changed, or I just didn't realize how expensive it is to run a company and the amount of money that can come out of a company. So again, wow, we're in the billions. Here's a good example of how much $1,000 investment, say in Yahoo, Amazon, eBay, and so forth, would be worth today. If you invested $1,000 in Facebook in 2012, only $1,000, just left it alone. This is a single investment, not a series of investments, a single investment. You would have $3,708. And people always say, oh, that's not a lot. Well, if you left $1,000 in your checking account or your savings account, you would still have only $1,000. We're talking about 10, 15 years later. So realistically, if you invest, your money has to grow if you are a strategic investor. Take a peek at Google, eBay, and Yahoo. $1,000, wow, look at Yahoo. You would have $33,000 sitting in your account. Now that's just kind of an idea of what you actually could have made if you got in. We always say that on the ground floor. Different kind of markets. Different kind of market. The primary market is where stocks are created. That is the initial offering. Secondary market is investors trade previously owned stock. They say, you know what, I've got Google, I've got, what's happening right now is Tesla. A lot of folks are unloading their Tesla stocks in the secondary market because they already bought it in the primary market. But now that Tesla is so involved in our political system and he's getting a little bit of egg on his face, so to speak, Tesla stock has just plummeted. And so everyone's trying to unload in the secondary market the Tesla accounts. Companies are not involved at all in the buying or selling of their stock because that's called inside trading. If you have a company, you can't be there saying, hey, yo, you should buy this stock. And hey, why don't you help me out with this? They stand away, they create the IPO, and they see actually what happens from there. What is a stock exchange? A stock exchange is something I grew up with in New York. I'm from Brooklyn, New York. I'm not sure if you read my resume or my background, but I grew up in Brooklyn. My godfather, who basically raised me, worked in Wall Street, and I was just always going down there and never understood it. I was just this little ghetto broke kid. All I knew was there's a bunch of big, gorgeous buildings, and it meant something about finance. So the stock market or the stock exchange, okay, are stocks, I should say, where stocks are bought and sold. The New York Stock Exchange, NYSE, and the American Stock Exchange, which is Amex, and then NASDAQ. And each one has specific things that happen within each one. And you'll see that. So the indexes are indices basically is a collection of stocks. representative of the stock market. So the Dow Jones, you hear on TV all the time, the Dow Jones went down by 200 points, or the Dow Jones is up by 18 points. Dow Jones itself is a mutual fund, or let's say, I won't get a mutual fund actually, I'll take that back. It looks like a mutual fund, but it is a combination of all these companies served, kind of formed as an index, and there are the 30 most significant stocks in the stock market, which means the most powerful companies, the ones that provide a great deal of yield to your investment. And there's 30, only 30, and it's very hard to make that list. There's a lot of criteria involved for you to say Pepsi, Coca-Cola is in the Dow Jones. If you ever want to know, punch up Dow Jones and find out who the current 30 most significant stocks are in the stock market, because they do fall off. S&P 500, you can see what that means. This is 500 of the largest companies on the US stock market. The largest. Now go back to the 30, says 30 most significant. Now 500, they are the largest. And then the NASDAQ, composite of all stocks on the NASDAQ itself, as you can see right here. So S&P 500, you can see Intel is there, IBM is there, Coca-Cola is there. They're part of the 500. Now the Dow Jones is 30. Coca-Cola is also in the, this makes sense, they're in the 30 most significant stocks, but they're also in the largest companies of the S&P 500. Hope that makes sense to you now. So how do you actually make money in the stock market? Well, stock goes up, and the stock that goes up should be sold. You buy low and you sell high. That's the concept. And you can see right here by this breakdown here, you say you want to get the dividends. Okay, not all companies do pay dividends, but let's say you go $50 a day, 12,600 a year. That's considered kind of a hustle. I'm sorry, my apologies. That's a hobby. And you can see what a side hustle is, the actual job, $258 a day, a day. Okay, you're looking at what your investment would be over a year's time. That's a full-time job. And then if you're doing $500 a day, you're doing a career in investment. You're non-stop watching your money. Sometimes we call that day trading. And also $1,000 a day, you're in business. So that's how you make money in the stock market. You've got to stay on it. There are about 250 trading days in a year. Every single day, you can trade and move your money around. So that is the end of lecture one, part one of Introduction to the Stock Market. From there, I'd like you to continue going through the PowerPoints and get more of an insight as to how it is to buy stocks and what stocks are really all about. And then we're going to shift gears and get into chapter 4, which is fundamental analysis, valuation models. How do you value stocks, and what models do we use to evaluate? I'd like to say evaluate stocks. All right, folks, we'll see you in 2 minutes and 2 seconds getting into chapter 4.